A little after 2:30 p.m. Eastern time, 12:30 here in beautiful Steamboat Springs, Colorado. And it's August 1st, and this is the live Market Structure Edge demo and discussion. And, oftentimes we tag team this. I've got some things that I want to cover, and Brian's probably going to weigh into. Brian Wilson, market strategist, is here as well. He'll make sure that everybody is in. And Henry is off today, I think. So Henry Howard is head of client services. We all three of us write the market desk notes. So we do that daily. And so as not to bore you, we shake it up. We give you some variety. So I've got a number of items to talk about here, and we'll always come back to helping you use these data effectively. This is a different way to think about trading and investing in the market, but it reflects the way that the market works. I don't mean to demean technical signals and fundamentals. Look, they're the two core things that everybody uses. What is the pricing behavior, and how are companies performing financially? Unfortunately, that isn't how the market works. That isn't what BlackRock, Vanguard, and State Street are buying. They buy value and growth, size, liquidity, low volatility, because they need the herd, not the outliers. And technical signals are a product of prices set by algorithms that are designed to deceive you. So they don't work very well. And I wrote about this. I think I wrote about it in the Modern IR blog yesterday. We write so many things. Sometimes I can't recall exactly where it was. But years ago, I sat down with a guy named Rajiv Ranjan, who was at the Federal Reserve Bank in Chicago. And Barry, if you don't, I'm going to mute you. Thank you very much. He's a high frequency trader. And we talked about how correlations break down to zero at the tick level. It's very difficult. If you're watching a pattern during the day, how do you know which way things are going to go? You could say, well, I look for these setups in the technical signals. Well, sometimes it works, but a lot of the time it doesn't. And it's because they're meant to fool you. I think it is much more reliable to take a long step back and look at the demand and supply in a stock in the broad market, and we'll walk you through that. I'm going to take you through those things. This is the setup and the summary, so you know kind of what to expect today, and understand volatility. And with those, it's not going to be perfect, but it's a very good way to put yourself in a position where you have a high probability of producing returns. And I will point out a couple of things here to begin. And I'll share my screen. We talk a lot about being aware of what is occurring in the marketplace, that it's not just, a daily metronome of things that are, that reflect what the company news is, or this thing or that everybody's talking about on CNBC. There is a cadence and a calendar. And we look at broad sentiment. I wanted to point this out very quickly. In this system message yesterday, I wrote this one. Sometimes it'll be Brian, sometimes it'll be Henry, but this was for yesterday. We'll archive these for you. I've got it on the engineering team's docket, so you can go back and look at these. But we said, at 10:07 a.m. Mountain Time, to understand that the move in tech and semiconductor stocks today is not fundamental. It's not fundamental. It doesn't reflect some sudden change in how people are thinking about semiconductor stocks or the tech sector. And you could say, well, they're rising because Jay Powell has now signaled that we're going to cut rates, and that's good for tech stocks. Well, is it or not? I was on CNBC with Brian Sullivan, whose show, alas, has been canceled. Last Call has been canceled. I mean, I think he does a great job on it. And I said, what difference does it make? Where interest rates are, there's no support from how the tech stocks perform to suggest that low or high interest rates is a lasting signal for them. And you can go back and look. That's not what does it. And month-end options used to track benchmarks expired. And that's very important stuff to know. Why? Well, this is what we think about all the time. What is the money doing, and how does the stock market work? What are 70% of US equity assets in retirement accounts following now. Models. They're not stock picking instruments. They follow models, and those models have to have weighting. And when there is a lot of volatility in the trailing month, there is going to be a rugged true up come the end of the month. And stocks can shoot up and then give it back because there are two parties to those transactions. We used to have on our team, I've mentioned this before, over at the other business, Modern IR, a guy that we hired who used to be at BNY Mellon, whose job it was at month ends to true up portfolios for index funds. So if you're supposed to have, let's just say, case of, as an example, 25% of the exposure in this index is supposed to be tech. And because tech has declined over the month, it's now only 21%. Well, you got to get back to your tracking. And you will have gotten a contract with a bank to supply you with a bunch of options or index futures to get you square. And if there's been a lot of volatility, one or the other side of those parties is going to lose. There will be parameters on those, you could call them contracts for difference. You say, well, index funds have to be long only. They're 40 Act funds. They can't be long and short and using derivatives. Well, 10% of their assets they can. And it's very important for them to track the benchmark. That's what they get in trouble for if they don't do it. Well, that can cause a lot of volatility that people misconstrue. So we try to keep you apprised of those things so you don't get caught out. And the best risk management tool of all, if you are very risk averse, is avoid them. You could go look at the calendar. I'm going to go out to broad market sentiment, but each time you see these, I'll zoom that in a little bit, these green squares, that indicates options expirations. These are periods where you could just say, well, we're hitting options expirations. Maybe I'll just take my money out of the market because I don't know what's going to happen. Demand was rising and supply was falling into July expirations, but not in tech. In tech, it was the opposite. So sometimes tech is so large that it can have that effect. And you could even use these data to know how to go long or short the market. And I'm going to talk about that too. But the easiest thing is you avoid it. So you could take your money out and maybe wait for supply and demand to get back to level. Here's the month-end expiration. Now you just see the piece of it because it was just yesterday. But you could avoid this whole period of volatility, and then you come out the other side. Now you put your money back to work, and you avoid all of that tumult because what really matters is the value of your portfolio. You don't miss out on anything. What is its value, and are you adding to it or subtracting from it? And I experienced both. Last week I put in I don't know where it was exactly, somewhere in here. I put in a long short. I had to work out with a trainer. So I put in an order long and short in the S&P 500, and I put limits on them. And while I was working out, I expected the market to decline. I look at broad sentiment peaking and supply rising, and I thought, well, it's probably going to decline. So I've got these orders in there, and the short order moved all the way to within 2 pennies of my limit order. And then it shot up because the market first rose and then it fell. And so what happened is my small long order filled and my big short order didn't. And I lost a little money on that because then I finished my workout and go, wow, crap, the long side filled. So I dumped that. So sometimes, you have the right strategy and the timing doesn't work, but you can always protect yourself. If you have a trade that isn't working, you can go, like, let's just say, I sold this today at, call it 29.54. So I bought this yesterday. I bought it yesterday and I hedged it. I'm more long than short because the market moved all of its volatility. I don't care what the conditions are. If the market moves all of its volatility, there is a high probability that it will give some of that back. Not always, but most times. And with options expiring yesterday and causing that, I knew what caused it. There was very high probability that a short trade would work, but I protected myself. So at the beginning of the day, I've got SPXU and SPXL, a little bit of them. And of course, they're offsetting each other. So I'm neither making money nor losing. And once the broad measure moved 50 basis points, I pulled the long side. And once I know that half of the volatility is moved this way and I'm levered, then I dump the long side. And because now I know probably which direction it's going to go. Plus, I could look at broad sentiment. It's still falling. Even though we have seen some moderation on the supply side here, broad sentiment is still falling. It hasn't bottomed yet. I think it will. This could change things today. But all of those things told me this is what I can do. And you can always do that if you have a trade that's going badly. You buy something you expect to rise and it moves against you. Well, buy a levered long vehicle if the market's rising. And now you've mitigated your losses. And this is the one thing about leveraged ETFs. I'm not embracing them. I'm saying they're risky instruments that can move very rapidly on you. And you have to realize the risk, but it's a very easy way to protect yourself when you're uncertain what's going to happen. Things don't go day to day.
Could you go back to the SPXU screen for a second?
Yeah.
Just a question for you in terms, Tim was describing a hedging process there. So let's say that you set this trade up yesterday at the close, Tim, and you thought,
yep,
the market's going to be down today. Would you set it up kind of like on a 2-for-1 basis? Is that how you would approach that type of trade?
Yeah. And if I'm not certain, I might do 50-50. If I don't know at the start which way things are going to go, that's what I would do. But yes, that's what I did. Yeah. So if you're, I'd like to be trading more, but because I'm doing too many things, my wife will not agree to it. And I can't blame her. I can't blame her. I said, well, I like to trade a bigger account, but I'm so scattered at times that with all the things that I've got to do, I'm not doing it. So I'm trading about $50,000, right? That's what it's an easy bit to make. So I had, call it, 30,000 short and close to about 15 long. So once the long, what's the move of 50 basis points? Well, it's not very much, It was, against that, I lost 150 bucks. Don't really care. I set I've got two positions now, and I'll talk about that. I set my stops 2.5% away. Well, I don't want to lose 2.5%, but that is the volatility of the S&P 500. So if I know I've got a supply demand advantage, the probability that these things are going to go down 2.5% from where I bought them is very low. Could happen. And if it doesn't, then I'm protected. Okay. That's all I'm going to lose. And it's a very easy way to go about taking distress out of the equation. Things don't go the way that you expect them to all the time. But if you protect yourself, you understand what's going on, you can put yourself in a position where you're not really worried about what's occurring. You've got yourself covered. And then how did I know to leave? So, it went up this is up 5.8%. It's an extreme outlier. I don't know where it's going to stop. So you have to be happy taking a piece of it. Since it's leveraged at 5%, it is up all of the S&P 500's intraday volatility of 2.7%, which is also the volatility. If you strip out Tesla and AMD that I like to put in that group as sort of the arms of the hurricane of big tech, it's 2.7%. We'll multiply that times 2. And it's 5.4%. So a 3 times levered instrument to consume almost all of that, well, more than all of that, that's at the extreme outer edge. I'm not going to try to capture all the gains. I would describe what we do here with Edge more like toll taking. That's what Citadel does. Citadel collects a fee from you for knowing demand and supply. That's what they're doing. They don't take any risk. They just take a little bit from you, 1/10 of a penny per share at a time. Well, we're kind of doing the same thing. We're saying we understand the context. What does the broad sentiment do? What are BlackRock, Vanguard, and State Street doing? Well, they're not buying equities right now. That may happen because how do we know? The broad sentiment is still declining. And supply, well, it's leveled off. They have not fully committed. You say, well, but the Fed's going to, cut rates. Look, I'm just telling you what we can observe. So we know that. We know that month-end options expired. We know these things are going on. Then we go look at the supply-demand balances. If this is what it is, I'm more likely to be short than long, particularly after a jump like that. That we know it's not sustainable. Now, tomorrow everything could be different. In fact, that's why I bought some long positions today. And I'm covering the things I wanted to cover. I bought a couple of things. I bought LAZ, and I have I have protection on this. It's down more than I would prefer. And you say, well, it's way past all of its volatility. Yeah, but I'm not really worried about that. I can see what's happening to generally um, financials, and they've reported results already. They reported last week, I believe, so I'm not concerned about that. That's a wild outlier. Now, maybe, as Steve Hicks has pointed out before, sometimes when it goes past all of the volatility, you can always go look at that. I'll show you really quickly here. Then it changes the math. But the reason I'm comfortable with this, so here's its volatility, 4%. Well, it's down more than that, right? So does risk increase? Well, a little bit. I bought Solve. It's down not all of its volatility. And why those? Well, they were ones that I mean, they're high probability trades. And if you look at the supply demand balance in them, that's what we're trading. Do I think that that's reasonable supply demand balance? Not awesome, but it's good enough. Probably the only reason that it's down more today is because it's not a 10 anymore. Tens with falling supply perform the best, and you can see what it's done. If it gets to 10 and the supply side falls, very high probability in 1 to 5 days that you're going to get a return. And sure enough, I think this is where it reported. So, is this perfect? No, it's still got pretty high volatility of supply, but that's why I'm comfortable. And sometimes it doesn't work out, but the odds are certainly in my favor. And why would I buy them today? Well, because I think, that you look at the trend in supply and demand in the broad market, probably that's going to bottom. Maybe I'm a little bit early. It's a new month. So generally, new money comes in. I'm comfortable that the market has dropped all of its volatility, so there is a higher probability of some recovery. Those things all work in our favor. And again, all you're doing is stacking the probabilities in your favor. It doesn't always work out exactly as you hope, but that's a very good strategy that reflects the mechanics, and that's what we're after. Okay, let me answer
Tim,
questions.
you covered two of the names. They were in the chat with LAZ and SOLV, whether they were potential good entry points today. What do you think about CRS?
CRS. I looked at CRS early, and I'm perfectly fine with it, right? I really don't care in some sense when I look at that list. Yeah, it's a tremendous, right? If you look at it, this is not in a daily trading ideas view, but that's exactly what you want to see. Plunging supply and very strong demand. And you always check the earnings calendar. Have they reported earnings? Very important. If they're reporting tomorrow, may not want to be in it. I'd look at that and say, well, probably does well, but you don't know. So I'll add that qualifier. So if we look at the daily trading ideas version of that, it will simply tell you here's your entry point, and here's your exit range. And what you could do, you could put in limit orders, but today the market turned over. It was a great chance to go back and look at some, and I took took a couple I was comfortable with. In some ways, this is superior. It's superior to Lazard. But yeah, to me, that's a very good opportunity. If it's in the entry range or lower, I guess we could go look, right? Why not take a chance? Just put your stop in place, right? Just make sure that you have some protection. And if you're fortunate to buy it in this range, so 141.52, and you want to put a 2.5% protection on that, what would that math be? So roughly $3 down. So you put your stop around 138.80. And you don't want to lose money, but then what's up 2% from your entry point? Well, call it 144 and change. That's all you got to do, right? Then you're not even worried about, well, what are the fundamentals? What are the patterns? Well, all I care about is, can I get maybe 2% or a little more in that stock? And if you can do that over and over, that's how you make money. Then you become a toll taker, and you're not concerned about what direction things go. Did you make the right decision? The math is in your favor. Okay.
Can I share my screen for a moment, Tim?
Absolutely. Because I'm largely out of material. I have
Okay.
I have a comment or two about volatility yet, but
And
the floor
and
is
Joel,
really yours now.
I'll address your question, Joel, that just came in about daily trading ideas. And I had a couple of things to show you. One of them actually had to do with volatility. So um, let's start off with the daily trading ideas. So if you're on the dashboard, you'll find the daily trading ideas right up top. And Joel, I'm not sure if you were meaning inside of IBKR or not, but inside of Edge, it's right up on the top of your screen. You just click on it, and then you can get to the momentum or the volatility names just right there. I did want to mention a couple of things about volatility itself, and just a reminder, and I'll share one of my portfolios. I've done this before, but it's just a way that you can use the system, and you can obviously set up any portfolios that you want to. I set up a triple Q portfolio, and here's a way that you can use this type of information. Let's say the market's down like it is today, and you're curious. You're like, are tech stocks down more than their volatility? Well, here's one way that you could address that. Just go to your portfolio. In this case, it's my basically NASDAQ portfolio. You can export this to Excel. You can do this with any of your portfolios. Export the data. Go and grab that. And then you can, in this case, we're looking at volatility. Just take a peek. What is the volatility for the Qs right now? And when that comes through, well, it's about 3.1%. Well, right away, you're armed with a lot of knowledge. You could do that. You could set up a portfolio for the Dow. You could, whatever you want to do. Then you're aware and you're not going in, blindly and just thinking, oh, it's down a lot today. This is a good, buying opportunity or whatever it might be. I did want to share with you. Let me minimize this for a second. This is a couple of reports that we use on the Modern IR side, but this represents underlying stocks for the S&P 500. And I just wanted to give you an idea of what the present volatility is and why it might persist here for a little bit longer. So if we look this once again, this is underlying stocks. 2.1% is the 200-day average. Look at how that's been climbing over time. Right now we're really out in front of our skis a little bit. That volatility really started to bubble in July options expirations. The counterparties were not able to contain it. Sometimes they are, but they were not able to contain it. Obviously, it bubbled over into yesterday's trading as well with end of month activity that Tim was describing, and it's bubbled over further into the beginning of August. So this just gives you an idea, all of its volatility for underlying stocks. That's what we're talking about. And when Tim, advocates maybe setting limits down about 2.5% or so for your positions, that's basically why, because that's how much a normal stock will move. Now, you noticed with the triple Qs example that I just showed you, that was a little bit more volatile. Tech stocks in general, are a little bit more volatile than the S&P 500. One other example with just volatility itself. This is with the SPY. So the ETF that you're familiar with, volatility is very different here, but notice that we have the same trend. It's going from 90 basis points and it's now up to 1.3%. So just trying to arm you with a little bit of knowledge here to just be aware of what volatility looks like in the market, and if the market is outside of its skis on a given trading day and that the data supports the market going the other direction, well, that might be an opportunity, as Tim described, where you could potentially set up a leverage trade, and you could set up those parameters to protect your positions at the same time. So hopefully that's helpful. Just wanted to talk through a little bit with volatility.
Great. Thank you, Brian, for doing that.
Yep.
That's very helpful. The only other thing that I've got on my docket here, and if we can let you go early, we'll do it. Nice if we don't drone on, is what happens next. We always like to think about that. And I'll just address that, Pam, or is it Pam or Robin? Robin, about back testing. I'll show you what I mean, and then we'll talk about what's next. And it's not on my, it's not the strongest part of the platform. We created it early, and we'll come around to making some improvements on it. But in the platform, it's really quite interesting. I use this with the market desk note today. If you just look at big tech and say, well, what if I was holding these in a longer portfolio, not trading like daily trading 1 to 5 days using probabilities and entries and exits, but what if I have them in a longer term portfolio? You could take what did I click? Did I click mega caps? Okay, just an example. So I'm going to click on Uber. If you click this, it opens the profiler. It is a blunt instrument back tester. It does not include supply. I mean, you can see it, but it gives you a broad way to think about what happens. If you were to buy Uber when it rose over 5 and sell it when it returned there, that's the default in the profiler. You could have avoided the 20% losses that Uber has delivered by buying and holding for 90 days. It didn't deliver return. The supply demand equation is terrible in Uber right now. It spent, of those 90 days, 43 below 5, 29 at 5, 18 above, 4 at 10, 9 at 1. Well, you want more blue over here for stocks that do well. But if you just take an example, if I put in Microsoft, and say this is just a 90-day default, because we do use 90 days a lot. Well, if you traded it like rises above 5, you buy it, and you just stay in it until it falls back to 5. That you only trade for 26 days instead of 90 if you were bought and held it, and you made 10% instead of losing 2%. Well, that's pretty good. Now, I think there are better ways to make money than this, but you could manage your portfolio this way. You could, in fact, we run data, and I'm very close to beginning to offer this. I don't have it right in front of me, but we run a low volatility portfolio with a target of 35 components. Can't always get there, and it finds all of them, and it gives us entry and exit criteria, and it's outperformed the S&P 500 this year. And it's longer term, but it's really predicated on, you want stuff that's 5 with falling supply, and when demand falls, supply rises, then you get out.
Atomic contract,
so
super small. We had that huge
the other.
Today,
can you mute that, Brian?
Almost 19,800.
Thank you.
And look at this,
yeah.
absolutely ridiculous drop.
So what you
We're
could
almost
do
down 1,000 points with no end in sight. And
there. Thank you. Yeah, please mute yourself if you could, but ask questions, fire away. I mean, you could do 1s and 10s. Is Microsoft good at 1 and 10? Well, in 44 trading days, you could have made 9%. Wasn't as good as just 5 and 5, because Microsoft is a value and growth stock. It's both. And so it spends a lot of time at 5. It won't be true for a momentum stock. So there's limited usefulness, but it's helpful to validate the data. This is alpha. If you could deliver a better return in less time, it frees up your money. If you could produce a return and avoid the times that things decline, then you can do other things with that money. That's the whole idea behind using demand and supply as a tool for trading. And Robin, this is the other thing. You can look at any portfolio. I've created a bunch of these. We put a bunch of them on the portfolio, on the desktop for you. But I look at AI, airlines. I don't trade these. Really, I trade the daily trading ideas. And then I use broad sentiment to go long or short, the broad market. Those are the two things that I do, and I use it for risk management. Do I need to protect my positions? Well, maybe. But you can see everything that is happening. What the supply-demand balance is. Money coming back into tech. No, but you could know it would probably jump yesterday. But unless and until this line rises back over 5, it is not sustainable, right? There is not much demand yet. And we're going to need to see more of that. If you look at we'll finish with this. What's next? Well, I think broad sentiment will bottom. and supply will decline. But if they don't, I said this before, without big tech, the market cannot sustainably rise. It will not sustainably rise on small caps. Here's small caps. There are 1,938 in the data set. This is what gave us that 10, 12% gain for the Russell 2000. Supply declined and demand rose, but it's over. And they're $2.6 trillion of market cap. Those 1,930, you can export them and tally it. That's it, right? That's less market cap than NVIDIA has. There is no way that can support the market. We have to have tech for the market to rise. So keep your eyes on that. I like to look at the mega caps. I just run a portfolio that has, as its criterion, the only criterion is market cap is equal to mega cap. Well, it's really interesting to see how many are in it. You could do this yourself. And there are 115 right now with, I forget who, I think it was somebody joined it. It was Ferrari. Ferrari is over 100 billion in market cap. And so, it's interesting to see. Without these are 75% of market cap all in 100 stocks. While it's not great, they had a dip yesterday, as you would expect. But is the demand side very good? No. So you can know all this stuff. You could pay people thousands of dollars to manage your money to try to give you, then you won't find more than this ability to see what is the supply and demand, because that's what it all comes back to. I don't care what the inputs are. All those inputs are going to show up in supply and demand. If it's the Fed, economic signals, stock picking, index flows, people betting, derivatives, all of that, the tremendous flow to ETFs, that's all in passive investment. We track that. So we're going to know what's occurring. And I think next, we're going to watch the data very carefully. This is the first thing I look at every day. What is the supply-demand balance in the market? Because that determines everything. Okay, I'm finished. Brian, you have parting words of wisdom? Or John?
I'll share one item, and it comes from just the screen that you were just on.
Okay.
So let me go over there for a moment. And it's under the notion of what's next. So this is a 1-year look. As Tim mentioned, we're not going anywhere without big tech. But we tend to see these run in patterns. This is a 1-year trend for short volume trending lower over time. And these, when we get covering, it tends to go for 5 or 6 days, tends to go for 5 or 6 days up. If the same trend holds true, maybe we get 5 or 6 days going down. I don't know for sure. But as Tim mentioned, we are getting close to bottoming here from a broad market sentiment perspective. If we do indeed bottom in the next couple of days, even with the weakness today, and we do get some short covering, we have some potential, to rally from here. We'll keep you updated tomorrow in terms of what we're seeing. Are we truly getting close to bottoming or not? And if so, that's a pretty opportune time to go long. But we'll keep you updated on those trends.
Good stuff. I think that's a good spot to end. Thank you fire away. If you got a question, John, you got something, go for it, please.
One question on what Brian showed, and then how frequently have we seen back-to-back days where we've been up, according to my volatility, like two standard deviations up yesterday, and now we're 2 standard deviations down. And so, have you guys ever seen that before?
I cannot recall. I would have to go think about it, but I think back in 2008 that happened. Okay. But yeah, it's very unusual. And an overall cautionary note, is that when things that bouncing against the volatility girders like that, those are not things that occur generally at a bottom. They generally don't. They generally occur at a top. Look, I don't know what's going to happen, but it continues to make me cautious. I said we haven't had a good entry point, by which I mean the broad sentiment drops below the green line. That last happened right here. And then, here at options expirations, we basically return to that price just a little bit after that. And we haven't gotten anywhere near that green line. Well, that makes me a little concerned. I think that is necessary for everybody, all the different motivations and purposes and time horizons that look at all kinds of factors when they commit money to equities or remove it, to be comfortable. So we'll see. But yeah, I mean, this is an unusual and challenging time, and I'm not sure exactly what's going to happen. On that positive note, we'll wrap up for now, and we'll look forward to doing this again next week. We'll see where we are.